So just on the question of why the 30% returns on a sustainable basis is very powerful leverage, well, that is very, very powerful because if you go to any high street bank, investors are receiving at most 4, 5, 6% returns on without risk. And that's in countries where the interest rates are high. And the moment you buy into equities, well, yes, it is true that you can make 10, 20, 30% on some years, but then on the bad years, you're also going to lose a lot of money. So someone who achieves a 30% return per annum and does so without correlation to the market, investors will die and bend backwards to give them their capital. And that's when you get into the big lever here, where you get to manage investor leverage, which is the healthy leverage, and can make a living comfortably off your trading. On that note, and that is another key takeaway here, is that if you're thinking of living off trading by starting out with very little capital, something like below hundreds of thousands of euros or less, then actually we think that it's much, much easier to manage those 1,000 to 10,000 euros in a way that's aiming at a 30% return. Because obviously in that situation, that's when you're interesting for investors. You can start managing 500,000, 1 million, 2 million, 5 million of investors' money. And then the market rates for that is to pay you 20% success fee on any upside you generate. And that is going to get you much, much, much more quickly to a life lived through trading than gambling for 100% returns on 1,000K. Because that can work for a couple of years, but then eventually everyone we've seen ends up burning. So much for the intro. Now let's go for the main results of our study on trading skills. So when at Darwinex, we have developed these algorithms to check for these investable attributes, these 6 investable attributes that are displayed. So one of them, I go through them one at a time, is experience. So we check for a statistical filter, allowing us to know if a strategy has been in the market for long enough to enable some conclusions. Then we have risk management, where we analyze whether the traders are deploying consistent leverage across trades and managing to a constant level risk throughout time for their strategy. That's one of the things we check. On discipline, we check to rule out loss aversion by the different traders. I'll get to that in a second. We check for the existence of stop losses and take profits. And then there's 3 more attributes, which we're not going to go into today, because the subject of today's webinar is to say that risk management, the second investable attribute, and discipline are the 2 investable attributes that correlate the most with long-term performance. So what this is telling us is that traders who manage the risk management and who display discipline last longer. And we also see that traders that last longer eventually develop winning strategies. And that's why the title of this webinar is Risk Management and Discipline are the key to long-term success. So I'm going to show you now some examples of what we consider risk management that yields long-term results. And here we see plotted the trades by one of the best traders in Darwinex, just as one example, who is very good at leveraging his trades with consistent risk. To go through the chart in a second, what we've got here, each of these dots is a trade that the trader took. On the horizontal axis, we have the duration of that trade. So in this example, most of these are between 1 hour and 8 hours, because that's his trading style. And then on the vertical axis, we have what we call deleverage, which you can think of as multiples of euro-dollar risk. So a deleverage of 1 is an unlevered trade in the euro-dollar. A deleverage of 5 is a 5-to-1 leverage trade in the euro-dollar, and so on and so forth. And then if the trader is engaging in different assets than the euro-dollar, then we translate that leverage into the multiples of the euro-dollar. And the key point here is that you see that good traders try to take all the trades with the same leverage. As you see, these dots are all close to a line, which is, so to say, the target leverage line for those traders. As a result, we see that the risk for those strategies, which is the amount that they could lose in the worst market 20, does not really change over time. So you see that this trader is following a pattern which more or less is constant over time and does not really move from this level between 5 to 8% of his balance at any point in time. This is what we call stable risk over time. And this is very important because if you always trade with the same risk and you are winning, then you know that you're winning because your strategy is working. If you're changing your risk all the time, then it could be that you're winning because you've just been lucky to take more risk on a couple of winners and take less risk on the couple of losers, even though this would make you think that you're actually winning, whereas in reality, it might be that your strategy has stopped working. And this is very important for you to not delude yourself, and obviously very important as well for the investors to think, okay, well, my trader has the risk management under control, therefore I trust him over the long term. To give you an example, I've taken two samples of traders who do not do so well on this risk management. So let's take the top for a trader who obviously has big changes in his monthly risk. So it could be that he's trading with pretty much no risk whatsoever. Then he very drastically goes up to a huge amount and then falls again. This is basically a situation where you have to ask that trader, so what is your risk appetite really? How much are you willing to risk when you go into these trades? Obviously, when you see these fluctuations in risk, then as I mentioned, there is no guarantee that the strategy is even working, because as I mentioned, it could be that the positive returns are an illusion, which is driven by few winners that happen to go well. But there's always the question, what if those winners had actually gone wrong? Maybe, all the money would have been lost. So as a corollary, the important thing to take away here is that all traders can lose sometimes. There's no strategy guaranteed to win. But the difference between good traders and bad traders is that the good ones, they know how much they lose when they lose. And the bad ones, all they do is lose everything, which is a whole lot worse than that. On another example, we can see the scatter plot of the leverage decisions taken by some different traders. A trader who's actually quite bad in his leverage consistency. And here you see that sometimes he'll take trades with leverage of 6, sometimes he'll take trades with leverage of 0.14, and that is a big fluctuation, because obviously you don't really know what drives these changes, and that doesn't give confidence in the risk management of that trader. Especially because it could be that a highly leveraged winner had gone right, but it could have gone wrong as well, and in that situation, it would be in big trouble. Okay, so that was so much on the risk management. So we've discussed that good traders trade with stable risk, and they try to enter all trade with similar leverage to make sure that the risk is under control. And traders who do not do that could be in a situation where maybe they make a big win and a big winner, but they could also make a big loss and a big loser, and that's precisely what makes him a bad trader. Which brings us to the next subject that we've also seen, and this is a classic. We call this discipline. And what we analyze here is each of these vertical bars is a trade taken by a particular trader. So a green bar, for instance, here, that goes up to give or take 1.5%, is a trade that opened at 0, obviously, went up to win 1.5% of the balance, and then eventually you see these small dots, black dots here, that was closed at 1.5%. Now, similarly, there are trades that go into negative, and what you have there is a negative excursion, where the trade was negative up to 5% in this particular case, and then the small dot is saying that it was closed at 5%. And very importantly, what we're trying to look for here is a symmetry between the size of the green bars and the size of the red bars. And we don't see that symmetry here, because, well, let's have a look. The best trade got to make almost 2%, but the trader allowed several trades to exceed the 4.8% threshold. So these two trades, one of them actually even got to lose 5%. And that's basically an example for traders who do not have the discipline to enforce the stop losses with the same level as they do the take profits. In other words, this trader could conceivably cut winners short and let losers run, which is a very, very bad indication, because that basically highlights that under pressure, such traders will just let the losers run, hoping that they will go right. And then sometimes they do go right, but sometimes they lose everything. And that's the last thing you want, because obviously once you've lost everything, your track record is ruined.